Hi, it's me again, Adrian, CEO of Skybridge International, Senyap Berhad. Now, earlier in the slides, we have shared what is debt service ratio. Now, you know that I would just like to share with you again, debt service ratio means your total liability divided against your total net income. That will give you a percentage. And also, I've shared earlier that the bank's benchmark or the bank's view is that as long as you're within the 80 to 85% debt service ratio, you're all right to apply for a new loan. But how do you actually go about understanding what banks look at as far as the debt service ratio? How do banks analyze your credit facilities? Now, when it comes to debt service ratio, it has many areas that the banks look at. One of which is your repayment capacity for your existing loans. Have you been a good paymaster? Now, don't be late in repaying your loans if you want to continue to be a long-term property investors. Continue to buy. The moment you actually stop paying or default in your loans one or two, three occasions, then banks may not be so favorable in your application for your new purchase. Yeah, and of course, also to understand when it comes to debt service ratio, you can actually apply beyond 80 to 85%. So this is not carved in stone. Banks do take into consideration your net worth, your net assets, like for instance, how much savings you have in your bank accounts, if your company is doing very well. So they're not just limiting to 80 to 85. They're basically using that as a benchmark. So don't be afraid if you think that you already reached the 85% debt service ratio mark, you won't be able to get fresh loans. That's not true. So you just make sure that you get all the brownie points by making sure that your documents are in order, your business are doing well, you have ample liquidity, ample of money in your bank accounts, and as long as you furnish this to the bank, I'm sure you'll be able to get fresh loans. Thank you. Join me again.